Hello everyone, I'm Jeff Brickman, Senior Investor Liaison at the Financial Accounting Standards Board. Thanks for joining this podcast for investors about a change that the FASB recently made to accounting for the income tax benefits of stock compensation. Public companies are required to apply the new rules by the first quarter of 2017, but some companies have already made the switch. FASB board member Mark Siegel is with me to explain the impact of the change to financial statements. Before we dive in, I ask you to keep in mind that this podcast reflects the personal views of the presenters and not official positions of the FASB. Also, some of the discussion involves tax laws, and we are not tax law experts. So let's jump in. Mark, investors might notice a difference in accounting for the tax benefits of stock comp that companies give to employees. In fact, a few companies already have made the switch to the new guidance, and it has been noticeable. Can you start us off by providing an overview of what the FASB changed?
Sure. Thanks, Jeff. The FASB recently decided that the tax benefits of stock comp, whether they're options, restricted stock, or other forms of equity, they should be included in the same line as all other income taxes in the income statement. The new rules will impact a company's effective tax rate, net income, and EPS. In the past, some of the tax benefits from stock comp were included in the income statement, and some were not. In fact, sometimes the tax benefits from stock comp were included directly in equity, so they never impacted net income or EPS. Those past rules created complexity for investors and companies because the tax benefits for the very same stock award were included in two different places. So the new rules basically say all the tax-related benefits from stock comp will go through the tax line in the income statement.
I know the recent change from the FASB doesn't impact how and when a company takes a deduction on its tax return for stock comp. It only impacts how a company reflects that benefit in its financial statements. But it might be helpful to step back and talk about the actual deduction that a company takes on its return.
Sure. I'll give you a high-level summary of how I understand it works for U.S. federal taxes and several other large countries. Keep in mind, though, that it varies based on the tax laws of each jurisdiction. For stock options, a company typically takes a deduction on its tax return when the employee exercises the award. The deduction typically doesn't happen when the award is granted or as the award is earned over a period of years. So if an employee does not exercise the option, for example, because it's out of the money, the company actually doesn't even get a tax deduction on its tax return. When an employee does exercise an option, the tax deduction is the award's intrinsic value. That is, the amount the award is in the money. For example, if the share price is $50 on the exercise date and the option strike price is $20, then the tax deduction would be $30. For restricted stock, a company typically takes the deduction on its tax return when the award vests. For example, if an award vests after 3 years of service, the award typically would result in a tax deduction in that third year. The amount of the deduction typically is the value of the stock on the vesting date. So if the stock price is $50 on the vest date, then the deduction would be $50. These tax deductions are real deductions based on a company's tax return, the same as deductions for cash paid to employees. So the tax deduction actually reduces the amount of cash a company will pay for taxes. In other words, there are real cash flow implications of these tax-related items. If a company makes money in the current year, then the stock comp deduction reduces the amount of taxes the company has to pay for the current year. If a company doesn't make money in the current year, then the stock comp deduction is added to the company's net operating loss, which is available to reduce taxes in future years when the company is profitable.
That's a helpful overview about the deduction on the tax return. Let's move to the financial statements. How and when are the tax deductions reflected in the financial statements under the FASB's recent change?
Well, the tax benefit a company gets on its tax return is the same amount that will be recognized in the income statement. The only difference between tax reporting and financial statements is the timing of when that tax benefit is reflected in the financial statements versus the tax return. This timing difference is like many other areas where there are differences between financial statements and tax returns. Because, for example, the FASB sometimes requires the recognition of an expense or an asset impairment before a company is able to take a deduction on its tax return. For the financial statements, stock comp and the related estimated tax benefit generally are recognized as the employee earns the award. For instance, consider stock options granted to an employee in 2015 with a grant date fair value of $100,000 that vest at the end of 3 years of service. The expense for the options typically would be recognized in the income statement over the 3-year period, or $33,333 each year. The estimated tax benefit for that stock comp typically would be recognized over the same 3 years. So if the tax rate is 35%, the tax benefit recognized each year would be $11,667 for a total estimated tax benefit of $35,000. The estimated tax benefit eventually would be trued up to the actual benefit when the company gets the deduction on its tax return. So assume that when the employee exercises the options in 2019, the intrinsic value is $120,000. This means the actual tax benefit the company got is $42,000, or $120,000 multiplied by 35%. Now, the difference between the actual benefit of $42,000 and the estimated benefit that went through the financial statements of $35,000, well, that's $7,000. That true-up of $7,000 would be recognized in the financial statements in 2019, the year that the employee exercised the option.
So that true-up between the estimated tax benefit and the actual deduction on the tax return is where the FASB's recent change comes in, right?
Yeah, that's right, Jeff. Under the old rules, some of those true-ups were recognized directly as an adjustment to equity, and others were recognized in the income statement. And to me, it never made sense that real reductions in tax payments due to a government were not reflected in the tax line of the income statement. The new rules have all the tax benefits running through the tax line.
Okay, thanks, Mark. Before getting into some of the financial reporting consequences of the change you just described, why did the FASB make the change?
Well, the FASB decided to make the change because we think it will reduce unnecessary complexity for investors and companies by requiring the tax benefits of stock comp to be recognized in the same line item within the income statement. Equally important, the FASB thought the change would provide better information to investors. The tax benefits that we are talking about are real deductions that a company takes on its tax returns. The deduction a company takes for stock comp are no different than the deduction for cash paid to employees. So the FASB decided that the tax benefits for stock comp should be reflected in the income statement just like the tax benefits for other employee compensation. To be clear, the FASB's new rules don't change a company's cash flows for taxes. The tax laws in the U.S. and some other large countries have permitted companies to take deductions for stock comp for a long time. The FASB's new rules only change the way those tax benefits are reflected in the financial statements by requiring that all tax benefits from stock comp deductions be included in that same tax line in the income statement.
Now that we have some background on the changes, can you describe the effects on the financial information provided to investors?
Sure. Recognizing all tax benefits from stock comp in the income statement will cause the effective tax rate, net income, and EPS of some companies to be more volatile. However, the quote-unquote volatility is really due to the underlying economics of the transaction. A company actually gets a deduction on its tax returns and therefore reduces cash outflows for income taxes when the employee exercises options or when the restricted stock vests. So to me, it's important to reflect those real cash impacts within the tax line on the income statement.
Makes sense. Mark, what information will investors have in financial statements to help them estimate the potential reduction in cash outflows for income taxes associated with stock comp deductions?
Well, the reality is that it's difficult to precisely estimate the impact of tax deductions for stock comp on cash flows. The amount of the deduction is impacted by the stock price on the date that the employee exercises options or the restricted stock vests. So an investor's ability to precisely estimate the tax deduction is about as good as the investor's ability to predict the stock price 2 or 5 or even 10 years out. However, financial statements include disclosures for stock comp that I think could provide insights about the future potential reduction in cash outflows for taxes due to stock comp deductions. So companies are required to disclose the total intrinsic value of stock options and the average remaining contractual term of options at the end of each year. They also disclose information about tax rates. For the tax return, the intrinsic value on the exercise date is the deduction amount. So an investor should know the amount of the deduction that would exist as of year end. But you have to keep in mind that the intrinsic value will change each day as the stock price changes. The remaining contractual term disclosure is the time left that employees have to exercise the stock options before the options expire. With those two disclosures, an investor can at least get some order of magnitude about how significant the deductions are going to be and roughly over what period a company will realize those tax benefits. So for example, let's say a company's intrinsic value for all outstanding stock options is $100 million at the end of 2016, and the average remaining contractual term is 4 years. Now let's suppose that employees had exercised all those options on the last day of 2016. The company would have a deduction of $100 million on its 2016 tax return, and this would provide a cash flow benefit equal to that deduction multiplied by the tax rate. So if the deduction is $100 million and the tax rate is 35%, then the cash flow benefit would be $35 million. In other words, the company would pay $35 million of cash less in income taxes for 2016. But we know in this example that the options weren't exercised at the end of 2016. They are outstanding and the employees have 4 years on average to exercise the options. While it's difficult to say what will happen to the stock price over those 4 years and exactly when employees will exercise, the two data points about total intrinsic value and average term provide some insights about what you might expect for future tax benefits. Similar information is required to be disclosed for other equity instruments awarded to employees, such as restricted stock.
Great. That was a helpful explanation of the cash flow impact of stock comp deductions. Mark, how can an investor know what tax benefit has been recognized for stock comp in the financial statements and what the true-up might be?
Okay, so let's start with the tax benefit already recognized in the income statement. That number is required to be disclosed each period. Companies disclose both stock comp expense recognized each period as well as the tax benefit they recognized. Now, moving on to the true-up piece, that's more challenging to figure out. That's because the deduction that a company actually will get on its tax return is based on things that are difficult to estimate, like the stock price a few years from now. But there is some information disclosed that can help an investor at least get some sense about the true-up and the period over which that would occur. The true-up is the difference between the benefit already recognized in the financial statements and the actual deduction, and that true-up could be both positive or negative. An investor can figure out the amount already recognized in the financial statements based on the disclosure, as I just mentioned. The amount of the actual deduction is the same as the cash benefit that we talked about earlier, the intrinsic value multiplied by the tax rate. The true-up is recognized in the financial statements in the period when the option is exercised or the restricted stock vests. Disclosure about the remaining term might give an investor a time range of when the true-up will occur, but it's not going to tell you the exact quarter, particularly for stock options.
I assume there are cases where that true-up can be quite large. Say, for example, if a company's stock price has increased or decreased significantly. Will an investor know when a company has a true-up? It seems like it might be important to know when there is a significant true-up because it will impact the effective tax rate, net income, and EPS.
That's right. The true-up can be very significant. The good news is that investors should know that the true-up occurred if it's significant because it should be addressed in the company's tax disclosures.
Okay, Mark, one final question for you. Some companies that disclose non-GAAP info make adjustments to net income to back out stock comp. Do you think the FASB's new rules will have any impact on those practices?
You know, I've never understood why stock comp is sometimes backed out of net income as a non-cash expense. Companies with significant stock comp plans commonly buy back shares with cash to offset the dilutive effect of options that are being exercised by employees or earning restricted stock. The cash outflows from those stock buybacks, by the way, those are classified as financing activities on the cash flow statement. I don't know whether many companies will change their non-GAAP practices as a result of the new rules, although I've heard some talk about companies considering a change. I will note, though, that if a company backs out stock comp expense from net income for a non-GAAP disclosure, then I also would expect to see a non-GAAP adjustment for the tax benefits that will go through the income statement as a result of the FASB's new rules. In other words, if a company is going to back out stock comp expense, then I would think it makes sense to back out the tax benefits from that expense too.
Gotcha. Thanks, Mark. That concludes our discussion. We've done our best to summarize an area that can be very complex in the real world. We would be happy to answer any questions that you have about the topic. You can contact me at jmbrickman@fasb.org or 203-956-5219.